hoping to see.
Yeah, sure, go ahead. So the ATRs for some of the stocks that you're trading, I think this will be very helpful. $4, wow. How many
Yeah, and then
days?
went back
How many days have you used to gain the ATR on Alibaba?
30.
30 days.
Yeah.
Wow, that's very surprising because when I do this, I only use maybe about 7 to 10 days, sometimes 15 days. But
Yeah.
as I said before, right, the more days you have, the more accurate that number becomes. And to see that at $4.40 is quite surprising. But again, it kind of gives you an idea that if this is a stock that moves $4.40 on a day, you know, just to make 50% of that, $2.20
Yeah.
is, it's possible, correct?
Yeah. And actually, the first 10 days, it was only a move of $2.10.
Mm-hmm.
Then the following 10, it was $4.60.
Okay.
And the one after that was, I think, 3.20. So, anyways, the average was about 4.40. And I, too, was surprised that it was such a big move in a day. I'm like, wow.
Yeah. Yeah, so I mean, the idea of doing the ATR technique is to give scalpers, like I know yourself, you like to scalp in the past, but it gives you an idea of, like if you can comprehend that in one day this stock moves, almost, $4, you can, if you're able to get proper trade setups, you can recoup at least dollar 50 out of these moves easily, right? So
Yeah.
it kind of helps you to avoid scalping and makes you focus more on how do I enter trades that will present me with a setup so that I can at least make $1 out of this move. So it's very, very
Right.
surprising to see. And I'm pretty sure after you've spoke with some of the guys in the trading room, there's a specific reason why a lot of them like trading Alibaba, right? And it's because of the volatile nature and the volatile action.
Yeah. Almost done here.
Okay,
There you go.
okay, that's awesome.
Took a while, but
But that's awesome, right? So it gives you a sense of like all of these products they range quite a bit, right? And I see a lot of a lot of products that are like within like the $1, $2 range, right? And a lot of these products, even though that they hang in $1 to $2 range, you can set up trades that could give you at least, 70, 80, 90 cent reward on some of these trades.
so, yeah, when I see those numbers, I'm like, well, I can shoot for half of that on all of them, and that would be pretty good.
Yeah, yeah, absolutely, right. And again, I mean, the idea is that like once you comprehend, like the probabilities of you making at least half of those moves, and then now you got to start looking about, okay, how much shares do I need to put on to make at least $200 from half of this move? Right?
Yeah.
And when you start asking yourself questions like this, this is the kind of like the cognitive thinking that you need to pose to yourself to come up with proper trade setup. So it helps you avoid doing things such as like over trading, trading when there's no proper setup, trading when you feel like the market is about to do like a big move and you just want to get in on the trade to catch some of those moves, right? But when you really understand that some of these moves can be quite big because of the ATRs on some of these tickers, you'll be more confident to hold on to some of these trades for a much longer period of time.
Mhm. How often do you update your ATR on a, or do you do it every morning?
I wouldn't do it every morning. I mean, to be honest, if you're savvy with Excel, if you're savvy with Excel, you can constantly update this information on a very quick basis.
Oh, you're right, just add one more day at a time.
Exactly, right? So I don't know how familiar you are with using Excel, but you just plot down this information. Let's say, for example, today at the closing of the day, you go in, you analyze the lows and the highs of the day, and you get the price fluctuation. Take that number, plug it into your Excel. If you're able to set up the macro so that it could automatically take in that new information from the new cell and add it to the total and then average out that number, you can do it very fast and it'll generally be very automated. So all you have to do is just take in that new piece of data from the end of the trading day and put it in.
It's a great idea.
Yeah. So I mean, yeah, I
You
mean,
stay
like,
away from
go ahead.
you stay away from the little ones like the ones that do $1 or less on average. Like, what's the
Yeah,
point
to
setting those?
to be honest, I don't like trading stocks that are I would say they're under $50. The reason being is because I typically find those stocks tend not to fluctuate much, right? Their
Yeah,
volatility is very minimal, and to be honest, as much as scary as volatility is in the market, right? Volatility is what leads to opportunities, right? You need a market to move quite a bit, to have those fluctuations in the markets for you to make money, right? And on stocks, like, I'll use like GE for an example, right? If you take a look at GE, it's a stock that, it's a household name, it's a very big symbol, very big ticker, but it just doesn't move much on a day,
that's true.
right?
Yeah,
So here, I'll give you an example here of GE. Just give me a second. Let me get back here. And so here, if you take a look at this and we compare that, right? Take a look at this and this. So this is GE, right? As you can see, GE
yeah.
opened somewhere around. No, it opened here, right? It opened around there on the day, and this is the highs of the day, right? And
Okay,
this is the
mhm.
the 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 low of the day so far, right? And so you can see here,
20 cents.
it went from 12.60 to 12.39, right? So I mean, it literally moved 21 cents, right?
Holy cow,
Now,
that sucks.
yeah, so now that's not to say that you can't make money off of it. It's just that when a stock only moves about 21 cents, like if you're not, getting in the market somewhere around here, right? You're not going to make much. Let's say, for example, you missed that move and you see that there, it went down and then it bounced and, you think that that market is going to keep going down and you enter in somewhere around here, right? At 12.50, right? You literally just made like 10 cents, 11 cents on the move, and
Jeez.
it's now like 1, 2 in the afternoon, right? So this is why I tend to not like stocks that aren't volatile in that sense. So I prefer trading stocks like Alibaba. It's probably one of my favorites because it fluctuates so much. And you can provide the same techniques in this, right? I mean, if you imagine that, like this is Alibaba and not GE, and you caught, the market, you realize that it bounced up here, right? And then it's coming down and you got in somewhere around here. Alibaba would have done maybe like a $1, $1.50 move on this leg down rather than a 10-cent move on this leg
That's
down.
right.
You see my point?
Oh yeah.
So that's the reason why I tend to not like, like these small traded stocks. I mean, again, it's all personal preference. It's your tolerance for risk, your tolerance for volatility, right? I know some people who don't like, taking on high amounts of risk because their risk tolerance is low, and so they tend to trade stocks like this. But me, I'm the opposite of this. My personality, I rather trade a stock that is more volatile, has more excitement, a little bit more action. I think that keeps things a little bit more fun for me. But again, it really comes down to your personality and your personal preference, right? Yeah.
Well, 10-cent move is not bad if you bought like 10,000 shares or something.
Yeah, yeah, exactly, right. And that brings me to my next point is that, you know, on a stock like this, you can clip 1,000 shares, right? And make, a 10-cent move on it and still make some decent money, right? And
Yeah.
you'd be
And if
off.
you're wrong, yeah,
Yeah, if you're wrong, it wouldn't be disastrous either, correct? Because it doesn't move, it's not
true.
that volatile, right? On a stock like Alibaba, like if you got the price entry wrong, and you're offside, it's not a great feeling if you're offside, right? So you got to be able to
Right.
stomach that. Okay. All right. So any other questions, Luke, before we move on with today's lesson?
No, I just wish that I had talked to you before I went into that trade. I kind of was,
Yeah. Yeah,
yeah,
yeah. On Tuesdays and Thursdays, I mean, like I'm there in the chat room, but I'm not as active because I am trying to prepare for our class, and it requires a little bit
of course.
of work and whatnot. So I do see the messages. I do see you, engaging and speaking with some of the other traders. Unfortunately, I'm not able to give you any feedback at the moment because I'm kind of like distracted on just kind of like prepping for everything.
And to be honest, I don't know if I like it that much, the chat room, because everyone had their own opinion. Like, there's
Yeah,
this guy that was long, and the other guy was short on the same,
on the same tickers.
I want, yeah, on the same ticker. And I'm like, so okay, who's right? And I'm like, you know what?
Yeah,
I'll probably do my own
yeah,
questions. I'll ask the coach because
yeah. You know what?
no.
You know what? You know what that does? For me, for somebody in my experience level, I like it when there's somebody long and there's somebody short, right? For two reasons. Number one, it shows you why there is a market, right? In a market, there's always somebody that believes a price is going up, and there's somebody that believes that a price is going down, right? And so just
Yeah,
being in the chat room and getting that sense of a market really happening, getting a sense of people's opinion is a great thing. Like when you understand financial markets from that perspective, right? Of how a market works. What creates a market is that you need a buyer and you need a seller, and you need these buyers and sellers to come together in order to create a market. But what one person sees as a price going up, somebody else may see it as, no, no, I'm interpreting this as the price is going down. And so they get together and they create an exchange, and that's what makes transactions happen in a market, right? So that is something that I like seeing, and I like people, giving out their opinions. But from my experience, you know, listening to people saying that, oh, I'm going long or I'm going short is probably not the best way to trade, because at the end of the day, you are the person that's executing the trades. You are the person that is responsible for your trades at the end of the day. So you can't be pointing the finger at somebody else if the trade goes bad, right? Because you are responsible. So you must understand that, like even if you're in the chat room, it's one thing to listen to what's going on. It's nice to get a sense of what I call the market chatter, because in the market, people are talking about going long, people are talking about going short. You need to be able to clear out all the noise and think about how you're going to set up your trade. And your trade may not be the trade that you are putting on, or that somebody else is putting on, excuse me, right? You may be looking at a completely different symbol, but it gives you a very strong sense of what people are doing, and that's why I really like it, right? And the second thing that I really like about the chat room is that it gives you sentiment, right? Remember, the market is all about sentiment. You want to get an idea of what people are thinking. I used to trade in a chat. I used to trade in a firm with over 200 traders, right? And the moment I walked into the office, I would get a sense of what the market was doing, not by looking at the charts or anything, but just by listening to the traders around me. By listening to the people
Oh,
around me, I can get a sense of what they feel the market is going to do, whether they are on a, whether they think the overall index is going to be bullish or bearish, the overall news that's going on in the market is going to cause upside or downside pressure. Just listening to the people around me, I can get a sense of what's going on in the market, and from there, I can begin to build up my own analysis about what I expect things will happen on the day. And then from there, you take your approach, but then you also, take your approach managing your own risk and managing your own trades and taking on the trades that you think have the viable setups, right? That becomes super, super important.
and the other day, I think it was yesterday, I was trading as well, and this guy just came in, did his few trades, and it's over 600 bucks, and then he went, okay, I go to my day job now, and everyone was like, what?
Yeah,
What do you
yeah.
do? Do you do it or something? Like,
Oh yes, that was Jacob. Jacob.
yeah.
Yeah. So Jacob, I believe he's a retired military officer in the U.S. and yeah, so he's got a very interesting background. I always respect the army guys because they always have to adhere to a certain level of discipline, of patience, of grit. These are all the qualities that good traders know, right? And so I really have a lot of respect for the guys who have gone to the army, and and to talk to him, I get a sense of like how disciplined he is and how much of a good trader he is and how responsible he is. Right? He watches his trades, very calmly. Sometimes he doesn't participate or engage in the chat room, but he's always there. He does his trade, even though we're talking about Alibaba and Apple and Square and Roku. He's probably trading like Facebook. Quietly trading Facebook, quietly doing his own thing, and he's very disciplined about his trade, right? So that's something that I really admire about him. And yeah, I mean, getting information and getting sentiment and getting ideas and whatnot from what these guys are looking at, will give you a sense of how to perceive the overall market, right?
But um, I wonder what he did because to get that kind of money, he must have traded right when the market opens. But
Yeah, yeah,
he,
yeah, definitely.
course, you
So so he
don't want to
he
trade the first 20 minutes.
he's a style of trader like you see here. This is the you see here. This is the first maybe about 30 minutes or so. He's
Yeah,
that style of trader. He likes trading that style, right? And I'd caution. I mean, unless you're comfortable doing it and you know what you're doing, I would caution this because it could be a real coin flip, right? Like the initial opening, you have a lot of algorithms, you got a lot of fund managers, you got a lot of HFTs, they're all over the place and it causes this volatility spikes that you can see here, right? And this is what makes it very difficult to trade the first, 30 minutes. And so I was always cautioned against that, but that's not to say I discourage you from doing that. You can try it out, and if you figure out a way to make it work, then by all means keep doing it. But if you don't, it's probably because it's too much of a coin flip, right? Because at that moment today, you will have traders who are saying, "Oh, I think the market is going up." They go long, and then the market's because it's so volatile, you can catch like a 60, 70 cent move in a matter of under a minute, and then the market can reverse from there, right? So it's too much of a coin flip to do that style of
yeah.
trading, right? But again, if you like that style of trading or if you want to try it, by all means.
That's the thing. I don't know. I would because how do you set up anything? There's nothing to base the day of because you just started, so you don't know where it's going. It feels like gambling.
Yeah, absolutely, right? And when you're trading like that style, right? I mean, the only thing you can look at is the S&P 500 futures index to give you a sense of, which direction is the market going down, or is the market going up? right? I mean, the futures market will tell you that. But then once the futures market catches up with or sorry, once the New York, um, the NYSE, the New York stock exchange, catches up with the futures market, right? If let's say the futures were trading up on the day, what will happen is that you'll see here how the market overnight on Roku, or sorry, on GE was trading low the previous day. Well, at 9:30, that market is going to gap here, right? It's going to gap up to reflect that the futures market is up, and then from here on, it could do this, or it could do this, or it could do a combination of both and close at the top, right? And the biggest issue here is that if you got, let's say for example, if you entered here, right? And the market went up, then it went down, then it went up, then it went down in that green candle, right? You are stomaching all this volatility because you didn't get the most optimal price, right? Some people, what they do is that they get in the market, and then the market goes up, they get out right away, and then they start shorting. So they start the scalping style, right? Those who scalp in this market will be able to make some money. I think that's probably more of his style. Jacob is that he likes to scalp the opening, right? But if you're not quick enough for scalping, or if you don't understand how to approach it properly, then it could be very detrimental. Okay?
Yeah, it was just exciting to see. I'm like, wow, the guy, he just spent 15, 20 minute trading, over 500 bucks, and then la la la. It's
He's like, la la
crazy.
la, I'm off to my day job. Yeah, no, I
But
do.
then, how often does he do that, right?
Yeah, yeah, exactly, right? I mean, like, a lot of times you got to ask yourself, how often are people able to do this, and how sustainable and how consistent is it, right?
Okay, sorry. Let's start.
Yes. So let's get started on today's lesson, which is advanced technical analysis for day trading. I'm gonna be honest and be straightforward here. I'm not a big fan of using indicators myself on my charts and whatnot. The reason being is because most indicators are lagging, and they're always after the fact, right? It's always after the fact. So you kind of gotta take like a shot, right? And ensure that when you're trading, you gotta kind of like anticipate, like a Bollinger Band about to break out, or anticipate, like the one of your oscillators, your stochastic oscillators, showing you that something is a little bit overbought or oversold, and that's always after the fact, right? And so I'm
Yeah.
not a big fan of using technical indicators for day trading, for my own personal day trading. I prefer to use inter and intra market correlations. What I mean by that is using indexes as a leading indicator into your trading because they are trading actively at the moment, right? Using other correlated products that have high beta to the markets as a leading indicator, and using proper risk management setups. Sometimes a lot of these technical indicators, they may great they may be great, they may be signaling that you should be entering the market, but you may not be entering the market with an optimal risk reward setup, right? So just a little FYI there. But anyways, forget what my opinions are. I think everybody should try looking at some of these indicators and try using them and seeing if they work for them, right? And if they do, by all means use it. If they don't, then try not to use it. There's many other techniques in trading, right? This is why trading is so fundamentally great, is that there's so many ways you can make money from trading. And it could be following technical analysis and technical indicators, or it could be manual execution. I prefer it to be more manual execution using my own thought process. I find technical analysis and technical indicators to be more systematic. If you like that systematic approach, that quantitative approach, then technical analysis and indicators and whatnot may be more for you. Right. But again, this is just something that I want to have everybody exposed to, and so that they can come up with the decisions themselves. Okay. So on today's agenda, we're going to be going over Fibonacci's first. I know you're a big fan of Fibonacci, so we're going to be going over that. Then we're going to be going over all of the technical indicators. So you have, your moving averages, your MACDs, balance volume, your ADX, your RSIs, your Bollinger Bands, and your stochastic oscillators. So Fibonacci. So before we get started on Fibonacci's, how familiar are you with fibs?
Um, as far as trading or in general?
Let's start off with in general and then trading.
Just know that the Fibonacci numbers or levels are found everywhere in the universe. They're like some kind of ratios that show up everywhere. Could be on a, like it shows on a picture, human body or plants, animals. It's found everywhere.
Hmm. Okay. And what about Fibonacci's in trading?
That's what I'm not too familiar with. That's why I'm excited to figure out what it means and how you trade with it, because if it's everywhere, it should be in the stock market too.
Oh yeah, it absolutely is. So definitely gonna have assigned a homework for you to look at some Fibonacci's on the charts, right? And we're gonna use various time frames and whatnot, and you're gonna get you're gonna get a very strong sense of how Fibonacci levels apply to trading, and how you can use Fibonacci's yourself in trading, right? Before I move on, I actually want to show you an example of Fibonacci's and trading, right? So I remember, I don't know if you remember, several weeks back, we had the China news, right? So there was news in China, news out of China, right? And this Chinese news was the retaliation for the Trump tariffs. And they basically went out and stated that um, they're gonna be imposing tariffs on the chip maker Micron Technologies, right? And so this happened roughly in the afternoon, and the moment that that happened, Micron Technologies dropped hard, right? Micron Technologies dropped hard, and I just want to put this up real quick and should give you an example of how um, Fibonacci's is used when it comes to trading news events in the markets. All right. So very quickly here, our topic of discussion. Take a look at this. So are you there?
Yeah, yeah.
So we can see right here. You know, this was throughout the day. You can see here like 9:30 started here. The market was trading. It was trading. Fairly normal day, right? 9:30 in the morning, 10, 10:30, by noon. It's a very average day. All right. And based on your analysis here, look at MU. MU on your chat box, you say it fluctuates about $1.50 on a day, right?
Yeah.
$1.50. All of a sudden, it's trading, 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 and then by noon, you have the Chinese government saying that they are going to be retaliating to the Trump tariffs, and they are going to be imposing tariffs on Micron Technologies and their chips, right? The moment that happens, look here. In the first 10 minutes of trading, MU went from here to here, which was about a $4 drop, $3 drop in a matter of 10 minutes, right? And the key thing here is that it continues to sell off. So you see the market's doing this. It came down here, it bounced fairly quickly, right? Came back down, went back up, then came back down, made this low, bounced back up, and then it began to consolidate, and then eventually closed out the day down here, right? Right. So on a trade like this, okay, look at what happened here. From when the news came out up here at this top circle to about 12:30, which was the bottom of that volatility, right? Look what happened here. This is how we use Fibonacci's to help us identify levels in which we'll know when the market will bounce off. Because when we look here, we can see that the market started to find support around the 38s and around the 61s, right? 38s and even around here, it closed around here, right? So these are all very strong Fibonacci levels that the market came and tested, correct?
Mhm. Yeah.
Right? And so this is how you would use an example of Fibonacci levels, right, to help you understand where you want to get in and out of the markets when the market is trading very volatilely like this. Isn't that crazy?
Yeah.
Seeing how the markets
Funny
bounce.
because it
Yeah, go ahead.
touched every single level. It's crazy.
Right. Exactly, right? And so this is why, yeah, we know that Fibonacci's is a very mystical, magical number that's known in the universe. But when we apply it to trading, you know, even within trading, you can see these numbers being applied through here as well. Interesting, huh?
It's so weird. Because,
So
yeah.
next time you get like a big headline or big news event that causes Apple to drop like $10 or Facebook to drop like $30 or something like that, pull out your Fibonacci's and draw it from here. It's very important to understand how to draw your Fibonacci's, Luke, right? And when you're drawing your
Right.
Fibonacci's, you want to use certain anchor points. So this here, the start of that move to the lows of that move would become your tops and your bottoms, right? And when you're able to identify that and know where how to draw it properly, you're able to find out all of these levels here within the markets. Okay?
Yeah.
All right. So back to our oops, back to our lesson here. So Fibonacci levels, and as we go on more, I hope you're going to learn more about this information. So let's just get started. Fibonacci's ratios of Fibonacci numbers, right? So they represent ratios of the numbers. They represent steps that are significant in some way and form useful levels in trading. So as you can see here, this picture, if you were to extend out your arm, from your elbow to where your basically your hand meets your forearm, right? And from your hand to the tips of your fingers, these are all very distinct Fibonacci levels in nature, right? If we take a look at our fingers, from every joint in our finger, we can still see that these are all significant Fibonacci's and levels, and they show up all over nature, all over the universe, all over the place, and that's what makes them very mystical, very magical type of ratios. I believe they it was called the golden mean, right? The golden ratios, for a reason. Okay. Fibonacci retracements, they can be used to identify key levels, right? And that was something that I showed you earlier on the example of MU and how we use it in trading, right? We use it to help us identify key trading levels. they require two significant points or anchors, right? And it's important to be able to identify these anchors properly because we want to use the highs and the lows of 2 points to help us set the Fibonacci levels, right? Identify levels in between these anchor points. These levels will be identified as those ratios, okay? And the levels are based upon the Fibonacci numbers. So as you can see here, this is the Fibonacci sequence. So if you take 1 plus 1, it equals 2. Now if you take 2 plus 1, that would equal 3. If you take 2 plus 3, that would equal 5. If you take 5 plus 3, that would equal 8. And if you take 8 plus 5, that would equal 13, so on and so forth. And that's how you essentially get your Fibonacci sequence. And that sequence, when you divide those numbers, will give you these ratios, right? So you will always get these ratios from these numbers that you divide, right? And as you can see here in this particular example with um, this is Texas Instrument, you can see here if you use this level here as your anchor point, so like the ultimate highs, and use this level here as the lows, right? We can begin to see where the market bounces at 50%, where the market hits your 31%, or sorry, your 61%, and where the market bounces off of your 38% levels, right? So it's very interesting to see Fibonacci's in action. So how to draw Fibonacci's properly. So select the Fibonacci replacement tool, select the Fibonacci retracement tool in the platform. So in the Haywood trading platform, just go into your drawing indicators and then you can select Fibonacci's. Right? From there, you identify a significant upper bound. The upper bound can be either the high of a candle or the head of a candle, right? And identify a lower bound. And again, the lower bound can be a low of a candle or the tail of a candle. So here is an example of Fibonacci's, and I specifically used many different trading products on purpose to kind of show you how much or how diverse Fibonacci's are, right? They can be used in various different assets. It doesn't matter if it's in currencies, in cryptos, in stocks. They can be applied to pretty much any product here, right? So you can see here in this particular areas where the market kind of acts as a support and resistance here at around 38, right? And you can see here how the market kind of acts as, again, even a bound, a range bound around the 50s. Okay. Here is an example of the New Zealand dollar. And as you draw from the highs and the lows, right, you're able to identify the low point, and this is a breakout, right? And this is the top. And in this specific event where you're seeing a retracement of the product, right, you can see that your 50% level is right around here. And look at how the market kind of like goes up, bounces off of that, comes up, bounces off of this, and then, keeps trading around these levels, and always reverting back to these levels, right? So in an uptrend, as you saw in the last trade, it works. It works on downtrends as well. And again, this is another example. This is on Euro USD, and as you know, in the currency market, you get a lot of volatility based upon news events and whatnot, right? And these news events here causes your Fibonacci's to break and move the price of forex products quite volatilely, and because of that you can use Fibonacci to get you a sense of where the market will retrace. So again, you can see here in this 50% line, here's our 100%, and you can see again the market bouncing around all these levels, you know, and then kind of like just hanging around here, right? So hanging around the 50 and the 61 levels. Um, if you use a tool like this from TradingView, so all the charts that I've showed you before, they're from TradingView. TradingView charts has Fibonacci's broken down even more, so it's not uncommon to see something like this here, where you have additional ratios, such as the 78 percent level or the 23% level on your Fibonacci ratios too. I'm pretty sure you're very common with these ones. These are the most common ones. You know, you have your 100, your 0, your 100, and then in between them you have your 38s, your 50s, and your 61s. This tool here from TradingView even breaks it down into 23s and 78s as well.
So it's not integrated in the platform that we use. It's not in Hayward.
Yeah, so it's not integrated in Haywood. The additional levels like this one, like the 76, is not integrated into Haywood.
Also, sorry, how do I use this then?
Oh yeah, you just go to tradingview.com.
For trading view? Okay.
Yes. Yes, and I'll show you how to use it. The it's a charting platform on the web, and we can talk about how to use this in a later date. Okay, but again here, many different examples here. You have your anchor points. You start off here at the bottom, and you draw it. This again is another. And I like using Fibonacci's on trading events, on news trading events. And as you know, in the forex market, it highly is affected by trading news. And so you can see here, as soon as a data point comes out, you have a lot of volatility spikes, and that spike right there will cause a high and a low. This is when you open up your Fibonacci's and you draw from the bottom to the top of those moves, and then you start looking at where the market will bounce off of your moves, right? And so here is an example of a product, the euro, which was affected by news, and now it's starting to bounce off of some of the Fibonacci levels over time, right? So I don't know if that was a
I think the
I'm sorry.
point is easy to do. I'm just thinking the first anchor point is easier to do because when do you know when the market is done going in the one direction, right? So you have to wait and start an anchor point to realize that actually no, it keeps going, so you have to wait. Like
Yeah, so there is a rule of thumb around that. When you're looking at news events, right? You want to like usually highs and lows of a news event will be established in about the first 5 minutes, right? And so when you're trading like a news event, let's say as a forex trader, you should be so familiar with some of the big news events that moves the forex products. Right. So let's say, for example, non-farm payrolls that's released at 8:30 in the morning, right? Let's say at 8:30 in the morning, the data comes out and it causes a large volatility spike, right? That volatility spike will establish a high and low of any particular product within like the first 5 minutes, right? So you can draw the highs and the lows there, and then look at the Fibonacci's to help you get a sense of what's going to happen. If if the market continues to push, that's when the Fibonacci extension becomes very important, right? And let me show you an example of that real quick. Okay.
I was looking for Fibonacci extension in Haywood, but it's not there either.
Yeah, it's not there in the Fibonacci's in Haywood, but let me give you an example using MU and Fibonacci extensions. So yeah, I think you're gonna find this one quite interesting. So here, let me show you this. So I'm put this up on the screen for you. And I find this quite interesting. This is why I always like playing around with Fibonacci's. Um, even when I'm like bored, just I generally like looking at charts and just playing around with it. But here's an example, okay? And I drew this from these two anchor points, and Granted that I drew it very quickly without much thought process, but take a look at this. Okay, so I took this, I literally just drew this as we were talking, but I took this anchor point here and this anchor point here, right? As you can see in here in your Fibonacci levels, right? Look at your 38% levels. Look at where all the support and the resistance happen around here in the 38% level, right? And even
Mhm.
here where the resistance happened, okay? That's your 38, okay? Now take a look at your 61, right? The 61, you have resistance here, you have a break of that resistance and a pullback, and then you have a lot of consolidation. You even have the market, trading within this range here, right? And that's just your 61s, okay? From your 100s or from your 100s to your 78s, take a look, right? This is just your normal Fibonacci's. From here to here is your normal Fibonacci. What's great about TradingView is that it gives you a Fibonacci extension, right? So from the top black line to the bottom black line, that's your 100% Fibonacci's, right? But this here represents your extension. And look what happens in the extension, where the market basically trades within this zone. And you see the market acting as resistance here in your 68, right? Or even here in the 2.681, you see the markets coming here, hitting resistance here before finally breaking out. Do you see that?
Yeah.
So this is how you would use a Fibonacci extension, right? And to answer your question, so I'm gonna bring back up that other the other chart that we were looking at. Oops. So to answer your question, how do we know if something is gonna continue going higher? The answer is we don't know if it's going to continue going higher or not, right? What we do know is that from experience, in the first 5 minutes of a data release, a high and low will be established. If you're able to pull out your Fibonacci's on those highs and lows and get the 0 and the 100% levels set, right? What will very likely happen is that if the momentum continues to go to the upside, your Fibonacci extension now becomes a key level to help you identify where the market's going to trade. Oops. Oops, I have no idea where that chart is, or that let me see. No, I can't find it anymore. But anyways, my point is that we don't know if the product is going to continue to experience additional momentum or not. What we do know is that using Fibonacci's extensions will be able to help establish additional levels if the market were to continue to experience additional momentum.
So you
Okay.
put your
Oh,
regular anchor points
I'm
thinking
sorry.
that
Can
it
you repeat that?
trades, but if you so just to try to understand, so you don't know if it's going to keep going up, but you establish your anchor points,
Yes.
and then it's going up, then you look for the extension to see if it's going to reach that.
Correct. Correct, right? And your extensions just becomes like a benchmark or an additional level, right? You always want to keep in mind, like all the other levels that we can look at within the market, right? Like your highs and lows, your gap levels, your previous day's close, your Fibonacci levels, and that type of stuff, right? We don't know which level the market will hit first, but using these as general guidelines for when you want to trade in the market, right? They become your entry or your exit points. Okay, and so
Yeah.
here, this was the previous slide. So before, and then you can see here afterwards what happens. Again, that same range was established, and then the market kind of just went lower and started touching the 68% level right there. Okay. Fibonacci extensions. So identify Fibonacci levels past 100%, used for anticipating support and resistance levels, potential profit target, right? And the key word here is potential, right? Sometimes the market may not hit the extended Fibonacci levels. They may hit one of the other reference levels that we discussed earlier, okay? And it requires your anchor points just like the Fibonacci retracements. So here is an example of Bitcoin, right? Everybody knows Bitcoin, the parabolic product right here. So this here becomes your 100%. This here is your zero or your 0%, your starting point. And as the market goes, boom, crazy, crazy, crazy consolidation, shakeouts, it comes back in, right? And it trades here past the 100. Where's it going? It's going to the next extended level, right? Your Fibonacci level, your 1.681 level, right there. Okay.
It's so crazy to me. Weird.
Okay. Yeah. So here are some additional examples of Fibonacci's extension. So again, you have your 100% levels here and your 0% levels, and then look what happens as the market kind of bounces, consolidates within the average Fibonacci's, and then boom, it takes you to the next level, which is the 68, and then from here you get to the next level, which is the 2.61. Okay,
Like a weekly or daily chart.
this one is a daily. So you can see up here.
The Fibonacci, does it work with any time frame?
Oh yeah, absolutely, absolutely, right? And that's what I want you to do for your homework. So I guess I'll tell you this now, but yeah, for your homework, try extending Fibonacci's on a weekly level, on a daily level, on a minute level. Again, here I'll show you another product that I, typically like doing Fibonacci's on, right? And I've done this in the past, so that's basically how I know. But and I'm pretty sure you can kind of relate to this because you're from Alberta, right? So here, just give me one second.
Going to show something about oil.
Yes, I am. So just give me one second while I pop this on your screen. But this is crude oil, and I do you remember the volatile crude oil back in 2009?
Um,
So
yeah, some, yeah.
so here it is. This is crude oil back in 2009, right? And I basically use this level here as my top and this level here as my bottom, right? And this here is a weekly chart. So this is going back very far, right? I mean, this is going back about 10 years now. Oops. We're talking about 10 years worth of backtracking on data, right? So weekly level right there. But take a look here on the fibs, right? Especially around here. Look at where the market bounce. You know, take a look here where the market bounce. And where do you think the market is going? Uh-huh, right? I mean, take a look here. Like, oh, there's a very strong chance that oil may hit around like $79, right? Take a look at the 50% level, or the 68, right? And not so much here, but again, you get a very strong sense that the 23% levels, the 38% levels act as very strong reference points for the market. And I really, now that I look at this, as I haven't looked at this in a while, but I really think the oil market has a strong chance of hitting here, you know. And now you're experiencing a pullback, but man, like look at that. Interesting, huh?
Hmm.
All right, so let's go back to here. All right, so here again is more examples of Fibonacci extensions. And you've noticed that I've used many different products, right? So this was the Dow Jones, Bitcoin currencies. And I did this on purpose because I want to show you that it's very applicable using pretty much any different type of asset that you want to take a look at, right? And on various time frames as well. So it's really up for you to play around with. So the next thing I want to talk about is Fibonacci levels in time. So Fibonacci concepts applies to time as well. Use times dates for anchor points and can forecast turning points and volatilities in the markets. Just 1 second, please.
You are now muted. You are now unmuted.
Okay, so let's show you some examples of Fibonacci time extensions, right? And so Fibonacci time extensions, you're basically, instead of looking at horizontal levels of price, we're looking at vertical levels in time
Mhm.
for Fibonacci's, right? And they can kind of like predict when the markets will experience turning points. Like for example, like around here, right? So things like that can become very interesting as well when you start looking at your Fibonacci's from a different perspective in time, right? And again, here, you have your 0%, you know, your ones, twos, and threes, and you can begin to see where the market will begin to come back and diverge back. Okay. There's one
How
more
do you set
thing.
those?
I'm sorry.
How do you choose or how do you set those vertical bars?
Yeah, so you have to use like a date or a time as a reference point, right? So when it comes to stocks, a very good reference point would be when was an earnings announcement release or when a significant event in the stock market happened, right? Those become very strong anchor points for trading stocks. Okay. If you're trading like futures or if you're trading currencies, you can use volatile events such as like an interest rate meeting event as an anchor point, and then you'll take it from there from that date and you move forward and you'll get a sense of what's going on. Okay. There's also something called a Fibonacci fan, which we're getting a little bit more fancy and a little bit more technical, but just give me 1 second here and I'll show you, Luke. And you're gonna be able to see um, some very interesting things here taking place.
So with those vertical lines, you start at one point and you add 1 day, and then two
Exactly,
days, then 3 days, and
exactly, right. And so Fibonacci's, I mean, we can we can spend all day talking about Fibonacci's because it's a very super interesting subject, right? But I want to show you this just because you're very interested in Fibonacci's and so am I. And we can geek out on this all day. But take a look at this one. This is called the Fibonacci fan, right? And it's the same product, oil. So it's same product, same time frame on oil. Okay. And when we take reference points here, we use this down here as a reference point. So this down here is a reference point, right? And we can see all of the times that the market kind of respects these fan levels, right?
Mhm.
So it's fairly interesting when we take a look at, like Fibonacci's, and we want to get a sense of, like how Fibonacci's applies to trading in various ways, you know. And this is basically it. You can see here we looked at Fibonacci fans, we looked at Fibonacci levels, Fibonacci time. This is a Fibonacci fan that kind of uses the same golden ratio, as you can see right here, the 25, 32s, 50s, 61, and 76. And instead of, giving you levels, horizontal levels or vertical time levels, this gives you diagonal trend levels.
Mhm. How do you
Okay.
set your anchor point? Same?
Yeah. So my anchor point, I use my anchor point down over here. So I set this one. This is my
Below?
starting
Yeah.
point. Right? This is my starting point, and then I ended it over here. I ended it over here. I could also start it here. I can also start it here at this point and end it up here, which I'd be curious to see what that would look like. Are you curious?
Yeah, yeah.
Yeah. Okay. So let me readjust that, and let's see what we get when we readjust that. Right. So let me see. So here, and I'll show you this again here. Okay, and 1 second. All right, so now that I readjusted the levels, so this is the anchor point, and this is the anchor point now, and we can begin to see some different things happening here. So you can see the 38% diagonal level right here. You can see a bit of bouncing here in this area and this area here. The 50% around here, you can see a lot of bouncing around here. And then the 25%, you can kind of see a lot of bouncing around through these areas here, but not. I wouldn't say it's as good as the other one, right? But again, I mean, if you take a look here from this level to this level here, this one's a very strong one, right? So you have a very strong reference point here, right? And even the 50%, I would say, kind of. It's interesting to see, but I mean that's the whole idea of using Fibonacci's, right? Is that it kind of acts as very good reference points for you. And again, you can play around with this. It's very artistic. That's one of the reasons why I really like it. Okay. Yeah. All right. Are we ready to move on?
Yes.
Okay, perfect. So let's move on. Oops. All right, here. So indicators in trading. All right, so indicators in trading, they're numeric measurements on the state of an asset. Examples of this would be trends, volume, volatility, liquidity, or even sentiment. Popular indicators that we're going to be going over include the moving average, the MACD, the on-balance volumes, the ADX, the RSIs, the Bollinger Bands, and the stochastic oscillators. So, word of caution before we move on: indicators work best when combined with macro data, intermarket correlation, or other underlying factors. Right? Most fancy indicators are just a moving average. Right, so it's important to understand this, and especially caution this is that you don't want to rely on indicators alone. You want to combine them, especially with intermarket correlations. So the correlation to a breakout with an index, or macro data, right, to give you a sense of when something's going to break out. Okay. So first one, the moving average. The moving average is the average price in a given period of time. Right? They can measure trends, support, and resistance levels. Period size is a sliding window. Right? What that means is that you can adjust your period, right? And it will readjust the moving averages. So that's a very common thing. Sometimes you get, a 7 day, 20 day, 50 day, 100 day, 200 day moving averages. And when you adjust these days, they readjust the information that you see on that. Right. So here's a window size or a period size. Um, this red line here is your 50-day moving average, and the yellow line here is your 50-day moving average, right? And you can usually tell which one is a smaller one based upon how much they change with the markets, right? So a smaller window size or a smaller time frame would very much hug the candles much more, whereas a larger time frame would not hug the candles as much. Okay? And one of my biggest tips for you, if you were to use moving average, is that moving averages, they act, I would say they act as a dynamic support or resistance level when trading in the market. So you can see here where the market kind of touched this and then bounced from it. You can see here where the market's kind of tried to touch this, or you can see here where the market is kind of hanging around that. Hey, this is what I mean by dynamic support and resistance. And what I and why it's really dynamic is because as new candles are printed, you get new candles printed in the markets, this line will readjust itself. Oops, I can't draw a line there with that. So this line here, this yellow line, will readjust itself based upon what's going on. Oops, based upon what's going on in the market, based upon that line itself, or based upon the candles. Okay? So the slope, upward slope is bullish and downward slope is bearish when you're looking at moving averages. Large window size accounts for more data, slow to change, so they're not so volatile. They're good benchmark for long-term support and resistance, as I mentioned earlier, right? So this here is a good benchmark for support and resistance. Common window size or common um, time frame for moving averages would be 50, 100, or even 200-day period, right? And so again here, you can see the moving average 100-day period acting as a dynamic support level here. And I would say even here, you can see that it does that as well. Small window size accounts for less data. They're quick to change, so they are more volatile, and they're good to measure. They're good to measure the most recent support and resistance in the markets. Common small window sizing can be 3, 5, 14, or 22 period moving averages. So common moving averages, you have simple moving averages. All candles are weighted equally. Then you have the exponential moving averages where more recent candles are given more precedent. Special case for weighted moving average, emphasis weight is different for different periods. Okay.
Mhm.
Do you use any of these moving averages yourself, Luke?
A long time ago when I started Forex, but I found them. You think they're showing you something, and then last thing you know, they're actually not good.
Yeah. And do you remember the period of the moving averages that you used to use?
14, 10 and 14 were the two most common.
10 and 14. So they're fairly short term, correct?
Yeah.
Do you use longer periods?
I think I've used the 50 before,
Okay.
but not so much.
Okay. Okay. Yeah, so keep that in mind when you're trading in the markets is that um, especially if you're going to be using any moving averages, is that you want to kind of use a combination of a long and a short moving average to kind of give you a sense of what's going on in the market. Okay, and and one of my biggest caution with especially with using moving averages is that don't just rely on them to make trading decisions. As you saw a couple slides earlier, you want to use moving averages in conjunction with another indicator, or in conjunction with macro data, or in conjunction with a another market, right? With a correlated market to give you a sense of what's going on and whether or not they will hold or not. So common moving averages, simple moving averages, all candles weighted equally, exponential moving averages, more recent candles. Oh, did I just go through this?
Mm,
Just give me 1 second. Oh, no. Sorry. So, simple moving averages, all candles are weighted equally. Exponential moving averages, more recent candles are giving more precedent. Special cases to weighted moving average. Emphasis weight is more different. Multiple moving averages. So two moving averages for different window size. You have a fast moving average and then you have a slow moving average, right? This is more common for when you're trading, and because the reason being is because it gives you much clearer signals about what's going on in the market. All right. Moving averages, the golden cross. Fast moving averages crosses above the slow moving average. It's a bull signal. The death cross is where the fast moving average crosses below the slow moving average, which is a bear cross. So, question for you: have you heard of these before? The golden cross and the death cross?
no, I haven't.
No? Okay, so the golden cross and the death cross is a technical signal within moving averages, and it basically means that when the slow moving average crosses, when the fast moving average crosses above or below the slow moving average. So when the fast moving average crosses below the slow moving average, that's a bear signal. When the fast moving average crosses above the slow moving average, that's a bull signal, right? And here are some examples of that. So you can see here you have your 100 in yellow, and you have your 50 in red. And as you can see here, this is a bear signal because your slow your slow moving average, the yellow one, is being crossed over by the faster moving one, right? And this signals a bear trend is about to be established in the markets. Okay. All right. And so you want to be careful with certain crosses like this, especially in sideways ranging markets if you're going to use these, because in sideways ranging markets like this, you can see these things crossing over, and they may not signal a trend is about to happen right away. You can see here the market does experience a little bit more volatility, especially in this particular area here where the markets kind of did this, and then some crazy wick happened down here before it traded higher, right? And you can see here your signal happened here and here, right? So you can get a lot of false signals into this as well. Okay, be careful. Moving averages, crossovers are frequent during ranges. Successive trade entries and exits can wash you out. So here's an example of all of these crossovers taking place again, right? And they do happen quite a bit, right? Especially if you're using this in a small time frame, right? You can see here in the first one when this was valid, right? Look at the time frame here, 1 day. These are day candles.
Okay.
So that means that cross took a while to happen. Whereas if you were to analyze this, let's go back to this chart here. Right, even this here was a day, but this here you're experiencing a sideways ranging market. In this chart here, look at the time frame. You're looking at 5 minutes. Okay. Your MACDs. Do you use MACDs at all?
No.
No? Okay. So MACDs, the moving average convergence divergence, they consist of two lines, right? So you have your MACD, your 12-day exponential moving average minus your 26-day exponential moving average. The signal line is at the 9-day exponential moving average. So they look something like this here, right? So this is here is your median point here, and then you have your crosses. So you have your cross here, your upward cross here, and your downward cross here. But let's go back here for a second. So MACD crossover, when your MACD is less than your signal sign, this is bearish. And when your MACD is greater than your signal sign, this is a bullish signal. Right, and so here again is an example. You can see the downward pressure when the MACD crosses over those lines. You'll experience markets moving down like that, right? And the opposite, when the market crosses over here, you'll have this taking place in the market. Okay?
I don't understand. What are the pink vertical lines?
I'm sorry?
I don't understand the pink little pink vertical lines.
Yeah, so so these lines here,
Yeah.
they measure the volatility,
Oh,
right?
okay. So just okay.
Yeah, so
Just the
they
volume
measure
of
the
the.
they measure the volatility, right? And these two lines here averages out those volatilities, right? And then you get a signal of when they crosses. Okay?
Okay, so you don't really pay attention to the pink, just pay attention to the crosses, really.
Exactly, exactly. On balance volume. So on balance volume was actually a very good indicator. I used to use it, but then it happened to be one of the indicators that I liked using, but then I kind of just stopped using it because I kind of just stopped using indicators outright. But on balance volume is nice because it tells you about what's going on with the volume trading in the markets, right? OBV, on balance volume, uses volume flow to predict changes in stock price. Increase in volume without increase in price equals bullish. Okay, so let me repeat that again. When you experience an increase in volume without an increase in price, that's a bullish signal. And when you experience a decrease in volume without a decrease in price, that is bearish. Okay,
Yeah.
so increase in volume, increase in trading volume without much change in price signals that the market is very bullish and that you're going to see a breakout happening. A decrease in volume without a decrease in price signals that the price is bearish. Okay, on balance volume shows buying and selling pressure, right? So you can see which side of the market is winning, the buying and selling pressure by looking at this. Look for divergence in OBV and price because the divergence in whether or not there is more pressure to on balance volume going up, right? And very little price change is a strong signal. Okay. So here you can see this is signaling to us that the market is experiencing a lot of upward buying pressure. Why is that? Is because you have additional buying pressure. So this here, the yellow line here, or the yellow line, sorry, shows upward buying pressure. The red line shows downward selling pressure, and you see that downward selling pressure is very stable, whereas the upward selling pressure is picking up. In addition to that, you don't see much changes in the price, right? And going back to our first point here is that an increase in volume without an increase in price is a bull signal. So here we're seeing an increase in buying volume without much change in the price, right? So this signals that the market is about to break out in higher.
Mm.
Okay. So here again, we can see an example of this is GBP CAD, all right? And in this example, there's a lot going on here. We got the Ichimoku clouds, we got the on-balance volume going down here, and you can see here the on-balance volume as shown by this yellow line is relatively low, right? So there's very low selling pressure, right? And there the price is actually pushing down, right? So this is where you can begin to see the divergence between the the additional selling. So we don't see any additional selling pressure as the price is coming down, and that's why the market ended up bouncing back up, right? As we go back here, a decrease in volume without decrease in price, right? So we have a decrease in volume here, but the price did not decrease by that much, right? Shown through here. And so that's why the market bounced back up. Okay. And again here, this is another example of a bullish signal where you have the on-balance volume picking up buying pressure, yet the market is still selling off, right? So the market is coming off here. The market is coming down even though we're experiencing additional buying pressure in the market. And then look what happens afterwards. Price continues to go up. Okay. The ADX, so the average directional index, it measures trends and it's composed of three lines. So the ADX line from 0 to 100 measures the strength of the trend. The DMI lines, the directional movement indicator, is a bullish and bearish, which is a directional movement index plus and a directional movement index minus. So it's like kind of like an oscillator in itself where it goes up and down, right? And here you have it basically indicates to you which direction the market is going up. Is it trending upwards or is it trending downwards, right? And so you can see here through your lines that the market, as it's trading through here, you have your first one, your ADX, right? And then you have your directional index, your negative, and your directional index positive, right? And when you see a cross through here, this is when you'll know that the market will experience the shift in directional change. All right. Your RSIs, so the RSI is your relative strength indicator. It basically measures overbought or oversold conditions in the markets. There's an index that ranges from 0 to 100. Low values equals oversold, higher values equals overbought. So overbought conditions, RSI is considered overbought when it ranges from 70 to 75. Avoid entering long positions when your RSI is trading within this range here. This range actually works really well for a mean reversion strategy, right? And I'll talk about this in a second. oversold conditions where your RSI ranges from 25 to 30, right? You want to avoid shorting positions here. You might want to consider doing the reversion trade in this particular case, right? And this works really well. Back to your example of Roku. So I just want to show you this. This was your example on the day, right? If we were to plot, excuse me, if we were to plot an RSI here, right? This is when you will begin to experience some overbought conditions if you have RSI, especially in particular in this zone here, right? You'd probably experience some overbought conditions there, and because it coincides with these levels here, this is when you should get the confirmation to start selling.
Yeah.
Okay?
Yeah.
And so here, this is within your average range. So the way you look at the RSI is that you have your average range here, and the RSI price will always range in here. However, you will experience oversold and overbought conditions in here and in here. Okay, and these are your conditions for when you want to apply certain strategies. So if you're using this RSI indicator, right, and you see the indicator is ranging within here, you're basically operating in normal conditions. But when you're seeing selling pressure, selling pressure, selling pressure, and then this cracks through these levels, right, that is when the signal from the RSI is telling you that the market is in oversold conditions, right? And when you're in an oversold condition, this is when you may want to employ a mean reversion strategy, in which when you see a wick like this taking place, when you see a wick like this taking place and it went down and then it went up really fast, you may want to get in a position here, have your stop set there, right? And have some targets to the upside. So you can have, maybe this as a target or maybe even this as a target for your upside. And so again, when you're looking at your risk reward, this is your risk versus this is your reward. Right? And so that's how you would use that for a mean reversion type of strategy where the market is going down, down, down. It cracks the oversold conditions, and you think the market is going to revert from there. That's when you can employ strategies like that. Again, always, always, always think of your risk management first. When you're entering a trade, you always got to think of, what, if I'm going to get in on this trade, and if I'm wrong, where am I going to get it out? If I'm right, where am I going to take my profits and leave? Right? These are the conditions that you want to look for when you're looking at this. Okay. Now, the other thing here is that, let me ask you this. Okay. If your RSI condition shows oversold, right? And it continues to keep going this way. Let's forget all this happened here. So forget all this, forget all that. Let's say the RSI shows that it's oversold and you think the market is still going to keep going. What kind of market is that? What kind of condition is that in the market?
What's the bearish?
Yeah, it's a bearish market, correct. It's also a momentum driven market, right? Where if the market price continues to go down more and more, it's a momentum driven market. So that's my point with the RSI, is that the RSI can act as a confirmation for a mean reversion trade, or it can act as confirmation that a trend is still intact. So as we can see here, especially in this particular area, you have the market going down and a downtrend being established, right? If this downtrend cracks the oversold level but continues to go down, it's very bearish, but the trend is still in place, correct? In this situation, you want to be continuously trading with the trend. So again, on a trend style trade, again, like this, you want to wait for a nice little pullback. And then you want to get short in the markets, the opposite of a mean reversion trade, right? Okay. So that's the general idea, is that when you want to use RSIs to help you trade the markets, you have oversold and overbought conditions. They basically lead to two types of trades. If you're experiencing oversold, overbought conditions and you feel that this is a little bit overdone, then what's going to happen is that those oversold, overbought conditions will lead to mean reversion trades. If you feel that those oversold and overbought conditions are false, then the market will still continue in a momentum style trading. And so you got to use momentum trade setups to give you that additional trades. Okay, so please be aware of that. And one last thing I want to caution with regards to oversold and overbought, I have seen assets overbought or oversold for months on end. Right, so just don't
Uh,
rely on one particular RSI signal. This is why, again, always cautious. Overlay your indicators with, maybe another indicator pairing like a moving average, or use overlaying of macro data or overlaying of intercorrelated markets to give you an idea of additional confirmation to get in a trade. Because sometimes RSIs can fool people, because I have seen these conditions of overbought and oversold within the markets extending, months at times. Okay. So here
so
again
what's
is,
a good,
yeah, go ahead.
what would be a great indicator to pair with the RSI?
With RSI, I think moving averages are really good.
Okay.
Because if a product was to be really overbought and oversold, and you are going to experience a mean reversion, using a combination of a short and long time frame in your moving averages to give you that crossover signal would be a very nice supplement to using RSI, or to use in conjunction with the RSI. Okay.
I
Or
see right there it says RSI 14, so that's the 14 period.
yep.
So if you want to do a moving average that goes with that, you would use a 14 average and then a slower one, or what?
No, I would use maybe like a combination of like a 20 and a 50. So use your 20
Uh,
as your slow moving average and a 50 as your fast moving average. Or I would play around with, 20 and 100, or 50 and 100. You really have to play around with it to give you a sense of, how to position yourselves properly to trade the markets. And again, it does take a bit of practice to get a sense of whether or not these indicators will work for you. So you do have to use a lot of analysis over a period of time to kind of get a sense of what's going on and how to use these properly. It's not something where you can just look at it once and say, oh, it's worked one time, that it'll work every single time. You need to really try to kind of like use this over a period of time. Okay.
yeah.
So RSI divergence, similar to OBV, we can look for divergence in price and the RSI. So again here, here we can see as the price in this particular area is going down, right? The RSI greater than 60 acts as resistance right here. So we can see that this is diverging here. And then finally, you can see your RSI leading to overbought conditions right here, and it eventually becomes overbought, which leads to this period here where the market finally breaks out.
About the
Uh,
RSI again, is it using 3070 or 2080 or what did it use?
it's 3070.
3070.
Yeah, yeah,
Is it
3070 is typically the default.
is it what you would use, or you would extend it to 2080?
Again, I would typically use a 3070, but I would caution, and just a bit of disclosure, I don't particularly use RSIs myself, right? And so again, I have played around with this before. I have used 80/20 before as a stronger signal, but again, I never found this to be that useful for my personal trading style. So take it with a grain of salt. I know for a fact on TradingView that you can modify these indicators to give you different trading periods. So instead of 14, you can use 20 over here. Instead of 70, you can use 65 and 35. It really depends on you and how you want to modify this. Okay. So again, this is more examples of convergence and divergence within the RSI indicators. Bollinger Bands. Bollinger Bands I really like. I think they're very good for trading. The only issue with Bollinger Bands is that they'll break out and then you'll be like, oh, they work, right? So like it's always an
Yeah,
after the fact type of thing, right?
right.
So that's my biggest pet peeve with Bollinger Bands, but they do provide a lot of good information. They are a volatility indicator, right? And they measure overbought and oversold conditions, similar to the RSIs. They're often overlaid onto the candlestick charts themselves. So just a little bit of information with regards to this. You recall this? I don't know if you ever experienced a stats class, statistics class. Are you familiar with his distribution bell curve?
No, sorry.
No? Okay, no, that's fine. That's fine. So a little bit of explanation. So your distribution bell curve, this middle here, this reference point here or this reference point line here acts as the average or the median, right? And this here's a standard deviation, right? So this represents one standard deviation away from the average, two standard deviations away from the average, three standard deviations from the average, and then anything out here further becomes an outlier, right? But that's essentially what it does. It measures products. So let's say, for example, if you take if you take numbers from 1 to 10 and you try to measure them out. So let's take, a sample of five numbers between 1 and 10, and, we try to average them out, right? Take like 5, 6, 7. Those are three numbers. We can add two more in there. We can add one as 10 and one as 1, right? These numbers, when we add them together, they will give us the average, right? This median point, right? And then each number, like let's say for example, what is number 5 in relations to the average? How close is it to the average? What is number 7 in relations to the average and how close is it? What is number 10 in relations to the average and how close is it to the average here? Right? Or what is number 1? And you'll see that 1 and 10 become outliers, whereas 5, 6, 7, they are fairly close to 1 or maybe 2 standard deviations away from the average price. Correct? That is how you look at standard deviations, and a Bollinger Band is just a build on the standard deviations understanding. So again, this is just another way to look at it, but it's a statistical bell curve where you have high levels of volatility and low levels of volatility. Okay. Bollinger Bands, they're composed of two bands. You have an upper band, which is your moving average, which is anything that's above standard deviation. And then you have your lower band, which is anything below standard deviation. The majority of candles should like within the bands, right? So bandwidth, low volatility equals narrow bands. And that's the key here when you're looking at Bollinger Bands, is that when the bands are tight, it means the volatility is low. The narrower the bands, the more likely they are to a breakout is to occur. So again, think of it like this, right? If the band is trading and it's getting tighter and tighter and tighter, what's going to happen is that you're going to experience a breakout and then you're going to experience like a wide gapping band in the price, right? Something like that. Okay, and it'll be more clear in a second. Uh, Higher volatility, wider bands. Wider bands is more likely to consolidate, is likely to experience a consolidation is near. 90% of breakouts occur between Bollinger Bands. All right, so here, support and resistance level, upper band equals resistance, lower band equals support, and often corresponds to existing levels. So here is an example. So here in this trading period, we notice that the bands are tight, right? These bands here are tight. They're tight, right? And then what happens when the bands get tight? They usually signal that a market is about to break out. And what happens when the market breaks out? Boom, you have a large pop in volatility, right? And so that's typically what happens. And again, here, you have the Bollinger Bands narrowing, 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 and then boom, you have your breakout, a spike in volatility causing that to happen. Okay? And here's an example of Bollinger Bands, respecting levels in the markets, right? And so this is why, you want to always use a combination of your understanding of markets, so understanding of levels, which is super, super important, understanding of Bollinger Bands and how these Bollinger Bands will experience stops in the markets when it hits a certain level. Support and resistance. Few closing bars should be above the upper band, below the lower band. Exception is a strong trend. So here is the exception to the rule is that typically you will see the markets trading something like this, where when the market is trading and it's volatile, you'll experience that the markets kind of touch the upper band here. So when the market explodes to the upside or the downside, it'll kind of hang within the band here, right? Every now and then you will experience this taking place right here, right? And this is because you have increased volatility that's trading outside of the bands itself. I believe this is the last indicator. So the stochastic oscillator measures momentum. It varies between 0 and 100, compares current price with the price range at a given window size, usually 14. Lower values equals oversold, higher values equals overbought. Overbought conditions, stochastic indicators has to be above 80 or equals to 80. Avoid entering a long position then. Stochastic oscillators, kind of very similar to the RSI in the sense that we can use them as mean reversion strategies to trade. So you want to avoid entering a long position there, and you may possibly consider entering a short mean reversion position. Oversold conditions, you have your stochastic indicators at 20. You want to avoid shorting position there, and you may want to consider a mean reversion strategy of going long. Right? And so here is an example of your stochastic indicators. And so you can see here when the two periods cross over, right? So your two periods essentially equates to your moving averages, right? And in addition to that, you have your stochastic indicator levels of overbought here and oversold here, right? And even here, when you're experiencing overbought conditions or oversold conditions in the markets. Okay.
It's like a combination of RSI and moving average in one.
Exactly, exactly. That's pretty much exactly what it is, right? And remember, a lot of these indicators are just built upon one another, and they just kind of like add one more bell or whistle onto a previously established indicator. So I mean, like the stochastic oscillators is really just kind of like a morph of a relative strength indicator itself. So be careful. Overbought, oversold conditions can persist in trends. Um, need more facts to confirm a reversal. So remember when I said earlier with regards to the RSI that oversold and overbought conditions can remain in markets for months on end? Right, so don't
Yeah.
just look at one indicator and be like, oh, the RSI says, oh, it's overbought, so now I'm going to start selling. You need more confirmation. You need to overlay that information. Okay, so here is an example. And this is on, take a look at this, one day where we have, this is probably about an entire month worth of overbought conditions in the market. Okay.
Mhm.
So combining indicators, no one indicator should be based of a trade. Indicators work better in combination. Combine indicators that reflect different aspects. So example, momentum and oscillators, RSIs and MACDs. So here's an example of MACDs and RSIs within this. So you can see as your relative strength indicator is showing you that the market is becoming overbought and oversold conditions, you can begin to see certain things taking place. So if we look here, at the very end. You can see here when your RSIs is at the lows and your MACDs is also hanging. Your moving average convergence divergence is also hanging at the lows. That's usually a strong sign that the market is about to reverse from there. Okay, Bollinger Bands plus exponential moving average. Bollinger Bands is volatility plus overbought oversold status. Exponential moving average is support and resistance in the markets, right? So here you have an example of your MACDs, or sorry, your Bollinger Bands and your exponential moving average working together to confirm the trends in the markets. Okay.